Hello there, so today's video is an update video on AT&T. We now have the Q4 2020 results out, so I'm going to be taking you quickly through the financials. I'll quickly go through the key points of the investor presentation. We'll talk about why people like to invest in AT&T. I'll give you the analyst forecast, and then I'll also let you know my own thoughts on what prices I think it's worth buying at. If you're new to this channel, welcome. My name's Andy, and on this channel I like to talk about money and success. If you're interested in making, saving and investing money, please be sure to hit that subscribe button down below, hit the notification bell, and then you'll get notified every time I release a new video. And if you enjoy this video and find it useful, please do remember to hit that thumbs up, because it helps the YouTube algorithm, which in turn helps me, and of course I do appreciate it. Now, before we get started, I need to give you a quick disclaimer. I'm not a financial advisor, so this is not financial advice. This is just my thoughts, opinions and feedback on the information that I've gathered that's freely available on the web. You need to do your own due diligence if you wish to invest in any stocks and shares. Don't be suing me, folks. That's what we're saying there. Cool. So why do people invest in AT&T? Let's deal with that one straight off the bat. Dividend investors particularly like it, specifically those that are looking for a high income. If you saw my retirement calculator, which I put out I think the week before last, then you will know that a high dividend yield means you need less money in essence to be able to retire. AT&T, let me show you a quick example. So AT&T, its current dividend yield is 7.19%. So if we whiz over to the retirement calculator here and we put 7.19% at the top there, if you scroll down to the bottom, you can see if you had an income, you need an income of 40,000, you would only need 556,328 in order to be able to retire. Now then, compare that, if you will, to just having 4%, which is what is usually sold as the rule. They always say the 4% rule, that's the amount. Well, if you only had 4% up the top here, yet you still want that same 40,000 income, now you need a cool 1 million. And that is why AT&T is so attractive for that income. Simple. That's the reason people invest in it. It's not for the growth, although it has grown its dividend for 36 consecutive years. Dividend growth is one thing we're going to talk about. If you saw my previous video, AT&T didn't increase their dividend. I'll put a link to that up there and in the description down below. Then you know that they didn't increase the dividend when we was expecting them to. I will be going a little bit more about that when we get to the slide presentation section. So I'll give you my thoughts on that as well and let you know what the company themselves have actually said. But first, let's have a quick look at the financials. So the first thing I want to draw your attention to is this assets, impairments and abandonments figure that you can see there, 16,365 million. So that's 16.3 billion, which is one heck of a write down. If you'd listen to the earnings call, you'll know that is mostly attributed to DirecTV. You'll notice that is an anomaly. That has not happened in any other year, so that's not something we're expecting to happen again. That, as you can see, has knocked the operating income down, so the operating income is a minus for that quarter, and obviously as a result the income therefore looks like a loss. So if you look at the net income or loss column, you'll see it's 13.5 billion loss, which is obviously not good, but that is because of that write down, so that gets lost again a little bit later. I want to just also point out the adjusted EBITDA margin, so that's the profit margin essentially. You can see it was 33% back in the fourth quarter of 2019. And if you look at the fourth quarter of 2020, you'll see it's 28.2%. But if you look throughout 2020, you'll see it's been in the same kind of range. So I'm fully expecting that that is going to recover and actually improve a little bit. Now notice the debt ratio has actually improved slightly. So it's down to 46.7%. It was 47.4% back in 2019. Now I also want you to look at the total employees there. You'll see that the total number of employees has actually been declining since December 2019. So they have been decreasing their employees, which will in turn decrease their outstanding costs. So on this slide, I just really want to point out that the repayment of long-term debt has been increasing. So they've been paying it off faster as time goes on. And I also want to just draw your attention to the dividends paid. You'll see how that's remained fairly static, slight increase, but fairly static. Now, I want to draw your attention to the free cash flow. Now, the free cash flow is the actual real cash flow of the company. So at this point, the write down that we spoke about earlier has been removed from the figures. So this is the cash that's left over, because if you depreciate something on paper, that doesn't actually give you a net cash loss. So whilst that 16 billion earlier looked really bad, and indeed was really bad, I'm not trying to hide that fact, it doesn't actually affect the cash flow of the company in terms of its ability to pay dividends or pay down debt. And that's what we're looking at now on this slide, the cash flow, okay? So the free cash flow, you can see that in the first quarter of 2019, it was 5.8 billion versus the first quarter of 2020, it was 3.9 billion. So that was down. Second quarter of 2019 was 8.8 billion, whereas second quarter of 2020, 7.5 billion, down again. Third quarter of 2019 was 6.2 billion. Third quarter of 2020 was actually up, and that was 8.2 billion. And if we look at the fourth quarter of 2019, that was 8.1 billion, which was brilliant. Fourth quarter of 2020 is 7.6 billion, so slightly lower than that fourth quarter 2020. So overall, 2020 was down on 2019, whichever way you slice it. But if we look at the operating revenues, you can see why. So if you look at any given quarter, you'll see that in 2020, it was lower than the equivalent quarter in 2019. So that's really the whole pandemic effect gone on there. They have, however, seen great growth in communications. You can see there that's mostly come from the mobility sector, which is much higher. I mean, it rose by 3 billion just in the fourth quarter of 2020, which is phenomenal, quite frankly. That's a heck of a growth there. And also you can see HBO, or Home Box Office, as they've written it there, had its best quarter, but overall, the Warner Media segment was down versus 2019, and that's going to be mainly due to cinema closures and a lack of releases. But personally, I'm expecting that to get caught up in 2021 and 2022 as those movies that have been made start to be released into the cinemas. So now let's look at their investor update presentation. So they are claiming they've made solid execution yield customer gains. So 1.5 million postpaid phone additions, highest since 2011. That's obviously good news. 1 million plus fibre broadband net adds with a market penetration reaching 34%. Again, excellent news because those are both recurring revenue streams. And total US HBO Max and HBO subscribers now top 41 million. That's well in advance of what their original forecast was. So that's all excellent news. They're claiming strong cash flow supports significant investment and shareholder return. They generated 27.5 billion in free cash flow, not to be sniffed at, in 2020, yielding a dividend payout ratio of 54.5%. Bear in mind that's on cash flow. And that's a good payout ratio, by the way, that's safe. They invested 20 billion in gross capital investments and significant investment in HBO Max. Personally, I'm pleased to see that. And effectively extended near-term debt maturities, reduced net debt by 33 billion since the Time Warner closure deal. Now, that's an important point there. So they've extended their debt maturities and they've reduced the rates at which they're paying them at, which means their costs on that financing, and a lot of people worry about the debt that AT&T have, they've reduced the costs of that and they're actively paying it down. And so far they've reduced it by 33 billion, which is not bad at all. And if I remember correctly, when I looked at the balance sheet, which I don't think I've shown you in this video, but I have reviewed that, it was 2 billion that they knocked it down by just in the last quarter of 2020. Now, bear in mind, off the top of my head, it's about 147 billion that they've got outstanding. So they've still got a lot of outstanding debt. There's no arguing about that. But they are knocking that down. But I'm going to speak more about the debt in a moment. So let's just carry on with these slides for now. So the 2021 priorities: 5G wireless, obviously that's going to be a big potential income stream. Expanding the breadth and reach of software-based entertainment platforms, by that they mean HBO Max. Deliberate capital allocation, so invest in strategic growth areas, 5G, fibre and HBO Max. Personally, I like that a lot because that does give the potential for increased income. Commitment to sustaining dividend at current levels. Notice it said at current levels, not to increasing, but sustaining at current levels. That's an important point. Remember that, please. Utilizing cash after dividends to reduce debt. Again, that's an important point. They've said after dividends. So they're utilizing the cash after the dividends to reduce the debt. So they are prioritizing dividends. So I'm not expecting any dividend cut, and they are looking to reduce the debt. That's important. Now, if we just quickly look at this slide, top left, you can see there the growth in their postpaid phone subscribers, and nice to see there's been a reduction in the churn. That's the rate at which people leave, basically. Their fibre subscribers, again, that's been increasing. This time, however, the yellow line, instead of being churn, is actually penetration. So it's the percentage of the market they're taking, which is great. Again, HBO Max at the top right there, you can see that's been growing nicely. throughout 2020, so we're very pleased to see that, and it's at a current all-time high, and I expect that to continue, and that should be a good source of income long term for the company. And premium TV losses, well, that's the segment that is declining anyway, but it's nice to see that the losses are at least getting smaller on the whole. So there's just a few bits I want to point out to you on this slide here. The estimated impact of the whole pandemic, they're putting at 8 cents per share basically on the earnings per share there, which totals at 2.5 billion. They're happy that they've had strong cash flows and liquidity, 7.7 billion free cash flow. This is just in one quarter, remember, which make 27.5 billion for the year. The total dividend payout ratio was 54.5%, which is obviously very good. The 2020 full year gross capital investment was around 20 billion, and they've still got 147.5 billion in net debt, which is down, so that has been reduced, so that's a good thing, but it's still high. And they've got 10 billion cash on hand at the end of 2020. Now you need to bear in mind there that they have been putting bids in for the C-band network, which they need for their 5G. We don't know how much they've bid, they've not been allowed to say. We're guesstimating, or I'm guesstimating, it's somewhere between 15 and 25 billion. Clearly they've only got 10 billion cash on hand. They're not going to spend all of that 10 billion. They might put 5 billion towards it. Now we know they've got the sale of Crunchyroll going through. We don't know how much they're going to get for that, but that they've said already is going to be used to paying down debt. However, they are going to need to borrow more in order to fund whatever they've bid on the C-band, but I see that as a necessary evil, and that money should come back. Say it's 20 billion, they should be able to get that back in fairly quickly anyway. So I'm not massively concerned about that, although of course increasing the debt is not a good thing when you've got a company like this that really you're hoping for them to decrease the debt. But they have no choice. They have to have access to the C-band in order to use their 5G network and make it competitive, basically, to make income from what you saw was already their growing mobility sector. And if you remember back earlier, that grew by 3 billion just in the fourth quarter of 2020. So there is obviously plenty of room for growth in that sector, and it's obviously highly profitable sector. Just one more slide to go through with you now, and that's this one, which is their consolidated financial guidance. So they're expecting the 1% range for revenue growth, wireless service revenue growth of 2%, and gradual improvement in Warner Media. I personally think once cinemas open back up, I think that the Warner Media segment will see that grow much quicker than they're forecasting there. I think they're being quite conservative. They're expecting their earnings per share to be stable with 2020. Their gross capital investment range they believe to be about 21 billion. Their capital expenditures 18 billion, and they've got a focus on fibre and wireless densification. They expect 2 billion in vendor financing payments and 1 billion in FirstNet reimbursements. They're expecting a free cash flow of approximately 26 billion, which is actually slightly lower, if you notice, than they had in 2020. So I think they're deliberately trying to be conservative here, because I would be amazed if they really expect that 2021 would be worse for them than 2020. And they've got total dividend payout ratio in the high 50s, which would actually be higher than it is now because it was in the mid to low 50s right now, but still under 60% should be fine. Long-term debt management, and here they say it again, utilizing cash after dividends to reduce net debt. So on that dividend front, you'll see there twice in that presentation they've said they'll be paying down debt after the dividends are paid, so they're prioritizing the dividends. However, they also said that their priority was maintaining the dividends, not increasing, but maintaining the dividends. Now, it's a hard one to call this, because this is a dividend aristocrat that's been increasing its dividends for 36 consecutive years so far. And if they don't increase their dividend at some point in 2021, they'll lose that dividend aristocrat status. So, there's a one side of things. Certainly, my optimistic side is thinking they'd be crazy. Why would they not do that? If they don't, you could expect the share price to fall. I think they will. I think they'll wait till later in the year to do it. So I think it may even be fourth quarter, but let's see. Time is going to tell, but I do think they'll raise it, and I think they'll raise it by all of a penny per quarter, basically. But again, time will tell. I think they're just delaying that, allowing themselves to pay down as much debt as possible, which is obviously great. But we'll have a look now at what the analysts think, and then we'll go back and I'll tell you my thoughts on the share price and what price I would be buying at. So here you have the analyst forecasts. Their 12-month forecast is 5 have it as a buy, 6 have it as a hold, and 2 have it as a sell. Overall, they've got it down as a hold. The average analyst 12-month forecast is that the share price will be $31.67. That's a 9.47% upside, which if you combine that with a 7.19% dividend yield, is not too shabby at all. The high, so the optimistic analysts think it will be a high of $38, and the low, so the pessimistic analysts think it could be as low as $24 per share. The current share price, in case you're interested, is $28.93 at the time of making this video. Ticker symbol, of course, is T. So what price would I be considering buying AT&T shares at? Well, for me, I don't think they're actually at a bad price at all right now. That said, I am not buying right now. My current cost base average for AT&T in my portfolio is $26.48 per share, which I do think was an absolute steal when they went down there. I couldn't help myself but buy. However, I would have the first buy price at $28.50 per share. I think that's a good price to buy. I wouldn't be loading the boat on that myself, but I do think if I was to buy in at that price and held it for any decent period of time, 3 years, 5 years, 10 years, I'd be hard pushed to lose money on that. The next target price I've got there is $27.50. $27.50. Again, I think very unlikely to lose money, much more likely to make money. And if it goes down to my target price of $26.50 or below, I will literally be loading the boat. $26.50 per share or below is an amazing price. Like I say, I got in at a price slightly lower than that. If it gets down to those levels again, I'll be buying. I am personally hoping for a market crash or a dip. If such a thing does happen, many shares will fall, this being one of them, and if it does, I will be buying at those kind of levels very heavily. The dividend yield then would be getting on for 8%. Bear in mind, my focus is passive income. I want to build up passive income, so I'm particularly interested in high but safe dividend income, and I see a telecoms company such as AT&T, especially with the HBO Max, fiber, and other subscription-based models that it's got online, as very safe in terms of paying that. And certainly currently at the current payout ratio levels, I think that will continue to be safe, providing they don't get in too much debt and their interest rate doesn't get increased. As long as they manage that debt and keep it down. So that's the key thing to keep an eye on there. And that's exactly what I'll be watching. And I will make update videos from time to time to keep you informed if you do happen to be subscribed to this channel. I have, of course, made previous videos about AT&T. You're welcome to watch those as well. I hope you found this useful. Thank you so much for watching, and bye bye.